Hey guys, welcome to Easy Peasy Trading Academy Forex Basics lesson number 1. We are excited to have you here, especially you new beginners who are interested in getting into the Forex market and you want to know what is this thing you've been hearing about Forex. Why is everybody doing it, or talking about it, and you want to know what it is. So this is a great place to start. This lesson will expose you to some of the concepts of Forex, what it is, why we trade it, how we trade it, what are we trading in the marketplace, who trades it. You'll get some of that stuff as you go along. And you will hopefully have what you need to make an informed decision as opposed to if Forex trading is even good for you. Not in this very first lesson, but throughout this first course, right? This initial course, you'll just be exposed and you'll learn. So just sit back and just try to, open your mind and see if you can, absorb this information. It's not as hard as people make it. Um, it has to do with your personality and your ability to discipline yourself and to follow rules, right? But it will definitely show you who you are. I love Forex for that because it showed me a little bit more about myself. I thought I was a patient person. I thought had everything under control as far as my personality in the business world, but Forex is a whole different market. So it was good for me to see that and to say, okay, these are some things I need to work on. I like that about what Forex. And if you're a person that likes to constantly improve and to grow and to learn new things, I think you'll be excited about this. So in this first lesson, we're going to go over the basics. But before we get there, I want you guys to take the time to read the disclaimer. I will pause. I will stop talking for a few minutes just to let you read it. And then I'll come back and I'll highlight some important things. It won't be a few minutes. It'll be more like a few seconds. But I'll take a second to stop and let you guys read. So in a nutshell, I don't know if you got through that fast. EasyP Trading Academy, EasyP Academy, myself, the affiliates, the agents, directors, officers, and employees do not guarantee the accuracy, validity, timelessness, or completeness of any information or data made available and assume. Here's the key part: no liability as to any loss arising from any investment based on the same. We're not asking you for any money. We're not asking you to do anything in particular. We're not advising you. We're not telling you. We're not soliciting from you. We're not licensed to even offer you financial instruments or advice. We're just giving our. I meant to say soliciting from you, right? I was reading solicitation and said soliciting, but soliciting from you. Sorry about that, guys. Personal opinions and ideas, okay? And we always say do not risk more money than you can afford to lose. We're going to guide you through helping you set up your demo account because we just suggest everybody starting demo for a little while until you reach some particular goals, and then to start with a small account, like literally take the money that you can afford to lose and put it in a side account. And then after you trade there, and then you can step it up as you need to, as you have control over your emotion for the most part, and that you have a good strategy. You should not trade unless you understand what you're doing, or at least your exposure to the risk of loss. If you understand that you can lose everything that you put in and some, depending on what you're trading, if you understand that, you are good with that, then okay, great. But if you don't. That's what it's saying. Disclaimer is saying. We're saying most people are going to tell you that. And of course, if things seem unclear to you, definitely seek independent financial advice. Okay. Now, when it comes to the content that we're sharing, like if there's a question that you just need us to expound upon a lesson, something brought to you, we'll do our best to answer your question because we are educating you, right? This is an educational institution. So of course you can ask us a question. But when it comes to financial advice or as to trading and even what your lot size should be in a trade, when we can't give you that, we'll suggest things to you and show you how to calculate it and send you to some tools. But we ourselves will not give you that. Okay. So now that we have the business out the way, I won't go through that a lot. I mean, it's the initial classes. I'll show you these things, talk about this, handle this business. But for you guys that are starting here, like the next lessons, it'll just be here. You can always pause it and read it, but I'll just kind of show it to you and just keep it moving. Okay. Now, what do you do for this class and any class going forward, always have your notebooks out and get ready to take notes. Notebooks, pens, pencils, whatever you need. Take notes. Even if you see a diagram, pause the video and try to draw it in your notebook. Your notebook is going to be tantamount to your journey to being a successful trader. And our goal is to get you to be the prop firm trader. Our goal is to help you get to the prop firm. That's what's a little bit different about us. Our end goal in mind is to help you trade for a living, to replace your job by trading with other people's money. If that's what you want to do, even if you don't, you'll still have the skill set to do that. Okay. You can use the study guide. We highly recommend we provide a study guide for you guys. Just use that. And we want you to go through those before the lessons. Okay. So we want you to go through the study guide before you see the next. If you see the next lesson come up, pause it and see if you can go through the study guide and see if you can answer the questions just based on the little pieces that you got from the previous lesson of what you've heard, and maybe use that, maybe do a pencil with that. So if you need to pause to get your pencil and get your stuff together, do that, but then come back and then do it that way. And then as you go through the lessons, reading along as you're listening, make your corrections. I promise you that's going to help you retain this a lot faster. And then write down any additional questions you may have, right, for the live Q&A session. So when you come live with us, when I say we're going to have a live Q&A, you can jump in and you can have your questions ready to put in there. And hopefully in the chat, we'll be able to answer all your questions. I'll have other people monitoring the chat to help you as well. But if for some reason your question doesn't get answered right then, be looking for it in the form of a video response of all the questions that we get to answer, or it'll be posted somewhere in our community. And so I definitely care about your questions, and I definitely want to make sure you guys are being attended to, especially you guys that are paying members. That's what you're paying for. You're paying for support. You're paying for somebody to support you. You're paying for this part. So I definitely want to make sure that you guys get your answers. Okay. So let's go ahead. Let's move on to our first lesson, which is the Forex basics. It's going to be a video. Actually, it's a succession of videos. It's going to be several videos. So you're going to see the lessons appear, the name of the lesson first. And then, like I said, I want you to pause it. Don't let it play. And I want you to write down, your answers in the study guide. And then I hit play and I want you to go through it. And then I want you to correct your answers as you go. Simple as that. And you see the next lesson, next one's coming up. Pause, see what you can do. And you'll start to be able to fill in the blanks as you get further along, because some of the things are repeated, right? The words and terminology, and it'll make sense, hopefully, as you get to the end. Of course, you're not going to understand everything. Some of these concepts are even complicated for some of us it's so complicated, it's hard to explain. I put it that way, but you will notice it, you'll recognize it, and you'll understand it as you go through. Trust me, you'll understand a margin call when you get your first margin call. You're like, oh, that's what it means, right? So just be patient, guys, and let's go from there. All right. 7 minutes in, talked a little too long, but I wanted to get, set the later foundation and the groundwork for the future lessons. So you guys know what to expect in lesson 2, for instance, that'll be coming up after this lesson.
Foreign exchange, or Forex for short, is the place where currencies are traded. Currency trading is the exchange of one type of currency for another. In the Forex market, currencies are traded in pairs. When a trader buys a currency, he or she is selling another currency at the same time. Currency values fluctuate based on various economic, political, and environmental factors. Forex traders sell and buy currencies in an effort to take advantage of these changes in value. The Forex market has no physical location or central exchange, as it is a global decentralized market and trades 24 hours a day, 5 days a week. No other market in the world trades more than Forex, which is why there are many opportunities for traders. That's Forex in a nutshell. Stay tuned for more videos.
So here's the information for the people who actually provided this content on their YouTube channel. You can go check them out.
A point in price, or pip for short, is a measure of the change in the exchange rate of a currency pair. It is the smallest unit of measurement we use when trading currencies. Most currency pairs are measured to 5 decimal places. For pairs like Euro US dollar, Pound US dollar, etc., a pip corresponds to the 4th decimal digit. Yen-based currency pairs like US dollar, Japanese yen are the exception and are measured to 3 decimal places. The pip value is shown in the 2nd decimal digit. If you are new to trading and still getting to grips with the basics, stay tuned for other titles in this series. They're on the way. Bid price is the price a Forex trader is willing to sell a currency pair for. Ask price is the price a trader will buy a currency pair at. Both of these prices are given in real time and are constantly updating. Let me explain in more detail. The British pound against the US dollar has a bid price of 1.2072. That's the price a trader wants to sell the pound US dollar. For example, a seller who thinks a currency will decline might sell at the bid price to take advantage of the fall. If the British pound against the US dollar has an ask price of 1.2074, that's the price a trader wants to pay in order to buy the currency pair. The difference between the ask and the bid price is the spread. What's the spread? Good question. Take a look at my next video and find out. A spread is the difference between the ask price and the bid price. For example, if the euro to US dollar is trading with an ask price of 1.1401 and a bid price of 1.14, then the spread will be the ask minus the bid price, in this case 0.0001. So a spread of 0.0001 is equal to 1 pip. For yen-based currencies like US dollar, Japanese yen, the spread is again the difference between the ask and the bid price. So if the Japanese yen to US dollar is trading with an ask price of 120.42 and a bid price of 120.40, then the spread will be 0.02. In this case, the spread of 0.02 is equal to 2 pips. In Forex, currencies are traded in pairs. The first currency in a pair, highlighted here in green, is called the base currency. The second currency in a pair, highlighted here in orange, is called the quote currency. The quote currency is sometimes referred to as the counter currency. The best way to understand base and quote currencies is in terms of exchange rates. An exchange rate of 1.1402, for example, would mean that 1 unit of base currency would cost 1.1402 units of quote currency. So, in this case, to own 1 euro, the equivalent of 1.1402 US dollars is needed. And that's that. Check out the next video for a more in-depth look at major currency pairs. The 7 most traded currency pairs in Forex are called the majors. They are the euro to US dollar, the US dollar to Japanese yen, the pound sterling to US dollar, the Australian dollar to US dollar, the US dollar to Swiss franc, the US dollar to Canadian dollar, and the New Zealand dollar to US dollar. The majors are often referred to by their nicknames: the euro, the yen, the cable, the Aussie, the Swissy, the Loonie, the Kiwi. Compared to other pairs, the majors share certain characteristics that make them very popular for traders. No wonder they make up about 80% of the traded volume on the Forex market. And those are the major currency pairs. Stay tuned for the next video that will explore another group of currency pairs: crosses. Since we covered the major currency pairs in our last video, now it's time to look at crosses. Currency pairs that do not involve the US dollar are called crosses. Some of the most actively traded crosses are euro to Japanese yen, New Zealand dollar to Japanese yen, British pound to Japanese yen, euro to British pound, euro to Swiss franc, Australian dollar to Japanese yen. Just like majors, crosses share certain characteristics that differentiate them from other groups of currency pairs on the Forex market. Here are some characteristics that give crosses wider spreads and make them riskier to trade than majors. There's one more group of currency pairs to cover. Join me in the next video when I discuss exotics. Since we covered the majors and crosses, now it's time to look at the final group of currency pairs, exotics. Exotics involve a currency from an emerging economy or a currency of a relatively small economy. Examples of exotics include euro to Turkish lira, US dollar to Turkish lira, US dollar to Mexican peso, US dollar to South African rand, US dollar to Singapore dollar. Exotics are riskier to trade than crosses and majors. Here are some characteristics that differentiate them from the other two groups. That covers all three groups of currency pairs, guys. See you next time. Now that we understand a little more about currency pairs and how their value is derived, let's talk about how they are traded. Currency pairs are traded in what we call lots. A lot is the amount of the currency pair that you're buying or selling. The three most common types of lots are the standard, the mini, and the micro lot. One standard lot is equal to 100,000 units of the base currency. Here are a few examples. The other two types of lots are the mini and the micro. One mini lot is equal to 10,000 units of the base currency. Here are some examples. One micro lot is equal to 1,000 units of the base currency. Here are a few examples. Now you know what a Forex lot is. Stay tuned for more videos coming up soon. Now that we have discussed what a lot is, it's time to discuss what a pip is worth. You will remember from our second educational video that a pip is the measure of the change in the exchange rate of a currency pair. But how do we calculate the value of a pip in terms of its monetary worth? The formula is simple. The amount of the base currency in lots times the number of pips equals the amount in quote currency. If you want to find out how much one pip is worth in euro US dollars per lot or 100,000 units of the base currency, it would look like this. For yen-based currency pairs, the result is a little different because the pip corresponds to the second decimal digit. Let's take a look at a practical example using a trade. A trader buys 1.5 lots of pound US dollar at 1.3030. Once the price rises, for example to 1.3043, he decides to close his position. He's made a profit of 13 pips. But how much did he make in dollars? The formula in the case of pound US dollar here would look like this. That's how you calculate the monetary value of a pip. Leverage is a loan provided to the investor by the broker and is expressed in the form of a ratio. Here are some levels of leverage provided by FXTM depending on the client's knowledge and experience. But what do these ratios mean exactly? Let's look at some examples. Say a trader has a capital of 10,000 euros and is trading with 1 to 100 leverage. Since his leverage is 1 to 100, he has a trading capital of 1 million euros. If he decides to buy the euro US dollar at 1.355 and closes his position at 1.3155, he will almost double his capital. Here's another example of the same trader, but with a different outcome. This time, the trader buys the euro US dollar at 1.355 but closes his position at 1.3005 and loses almost half his capital. So it's important to remember that leverage increases your trading capital, providing opportunities for multiplied profits, but it can also multiply your losses too, so use leverage wisely. Now that we have understood the concept of leverage in Forex, let's talk about margin. Since a trader is allowed to use more capital than the amount he or she deposited, the broker requires an amount of funds to cover any potential losses. This amount is what we call margin. See it as a good faith deposit, represented as a percentage. It is the amount you need to have in your account in order to keep a position open. Let's look at this example. A trader deposits $20,000 in an account with leverage 1 to 25. The broker has set the margin at 4%. What does this mean? If the trader buys 2 lots of euro US dollar at 120, you can calculate the margin like this. He must have $9,600 in his account in order to keep his open position. Simple. We'll be getting into balance and equity next before we come back to margin, so stay tuned. Balance in Forex refers to the amount of money you have in your trading account. It's important to remember that your balance doesn't include any profits or losses you might have from any open positions. If you have open positions, your balance might change depending on the losses or gains you've made once the trade is closed. The balance amount is displayed in the terminal window under the Trade tab on your MT4 client terminal. If you're using the MT5 trading platform, then the balance is located in the toolbox under the Trade tab. Now, you may be wondering, what is the difference between your balance and your equity? Look out for my next video, which will be explaining equity. Now that we covered balance in our previous video, it's time to understand what equity means. Many traders get these two amounts mixed up. Remember that equity in Forex refers to your balance plus any profit or loss from open positions. But if you don't have any open positions, then your balance equals your equity. The equity amount is displayed in the terminal window under the Trade tab on your MT4 client terminal. If you're using the MT5 trading platform, then the equity amount is located in the toolbox under the Trade tab. So now you know the difference between balance and equity. Free margin, in its simplest definition, is the money in your trading account that is available for trading. It is calculated by using this basic formula. Remember that equity is the balance, plus or minus any profit or loss from open positions. Let's take a look at this example. Say that someone enters a trade with the following conditions. Decides to buy 2 lots of euro US dollar at the exchange rate of 1.20. So the transaction will amount to 240,000 US dollars. The required margin for this position is calculated as follows. 240,000 divided by 50. If after entering this trade the price of euro US dollar fell to 1.1905, he incurred a loss of 0.0095 pips, which is equivalent to In this case, the trader's free margin would be In the next video, I will tell you all about margin level. Stay tuned. Margin level indicates the health of your account. It is the ratio of equity to margin used for your open positions and indicated as a percentage. It's easily calculated with the following formula. Let's take a look at an example. Say a trader has the following equity and used $1,000 worth of margin. As we can see, this trader's account is still very healthy. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. Next up, we'll be looking at margin call. This is a notification which alerts you that you need to deposit more money in your trading account or close losing positions to free up margin. Margin call is denoted as a fixed percentage determined by the broker. You can find the margin call percentage in the account specifications of your trading account. When the market is moving against your open positions and the margin level falls to the margin call percentage, you can expect to receive a margin call warning on your device. In other words, it is a warning for the trader that the stop out level is approaching. In the example here, the trader is getting closer and closer to a margin call. Don't forget that your margin level is your equity divided by used margin times 100. If his margin level decreases further to 40%, he will get a margin call. So make sure always to keep an eye on your margin level, guys. Till next time. Now that we have covered free margin and margin call, it's time to look at stop out. Stop out is the level at which the broker starts closing the least profitable open positions in order to free up margin. At FXTM, you can see at which point stop out will be initiated for each trading account in the Trading Accounts Overview section. As you can see in this example, there's a stop out level of 20%, while the margin call is at 40%. What does this mean exactly? Well, in this case it means that once the trader reaches 40% of his margin level, he will get a margin call. If the trader doesn't start closing his least profitable positions and he experiences further losses that bring him to 20% of his used margin, stop out will be triggered. So now you know what stop out is. Here's hoping you never have to experience it. Till next time. A swap in Forex refers to the interest earned or paid for keeping a trade open overnight. There are two kinds of swaps: swap long for long positions and swap short for short positions. Both of them are expressed in pips per lot. Swaps are part of the contract specification for each financial instrument. Here's an example. If a trader shorts on Euro-US dollar by one standard lot on a Thursday and keeps the position open overnight, closing it on Friday, the swap short formula looks like this. Now, if the trader goes long on Euro-US dollar by one standard lot on Thursday and he only closes his position on the following Tuesday, the swap formula would look like this. In case the same position is kept open until the following Thursday, that would make it 7 nights. Weekend swaps are applied on Wednesdays. Here is an example of that. Trader shorts Euro-US dollar on Monday with one standard lot and closes on Thursday, so the position remained open for 3 nights. On Wednesday midnight, the weekend swaps will be applied as well, raising the nights to 5. Now you know how
Okay, guys, I was going to say, now you know how swap works. Till next time, folks, trade wisely. Okay, so seems kind of long, but each concept was under 60 seconds or less. So you can always go back through. There are 19 concepts or terms, basically, that you guys just learned. So definitely go back through, and you guys have notes of each section. So review your notes. Hopefully you were able to fill in the notes. So now it is quiz time. Let's put your knowledge to the test. Let's see if you paid attention, and let's see if you can, get these answers correct. So let's start with the first one. We're not going to do all of them. We're just going to do 10 questions. I just wanted to give you an idea of what the quizzes look like. Okay. So the first one, these all fill in the blank. So fill in the blank. Foreign exchange, or blank for short, is the place where blank are traded. So what do you think that is? Foreign exchange. What does Forex change stand for? Kind of told it to you. Slipped up. Right. I hope you guys said that foreign exchange, or Forex for short, is the place where currencies are traded. So we don't trade gold, we don't trade indices, we don't trade stock, we don't trade shares, we don't trade bonds. We trade currencies in Forex, and Forex is short for foreign exchange. That's the basics. You got to know that. Forex, we trade currencies, okay? Now, in the Forex market, currencies are traded in what? So how do we trade these currencies? If this is actually taken directly from the video, okay, and they should be in your notes as well. So you guys should know the answer to this one. They are traded in pairs, okay? Think of the currency pairs as a seesaw, but it doesn't work the way the seesaw works. It only just that you need two pieces on the seesaw to trade, right? So if you're going to trade GBP, you can't just trade Great British Pound. You got to trade against something. So you got to trade against the dollar. That's the other side of the seesaw. Or you got to trade against the Japanese yen, or you got to trade against the euro. So you got to have two together, two different currencies to trade a pair. And remember, the one in the front of that list of GBP, USD, for instance, is the base currency, and the one in the back on that pair is the quote or the counter currency. So you should have that in your note as well, because the base currency is basically, when you're looking at the market, that's the currency. If you see it going up, the base currency is going up. If you see it going down, the base currency is going down. I'll show you guys what that means in the future. But just keep that in mind. They are traded in pairs. You cannot go buy the dollar by itself. You got to buy the dollar against something. The Forex market has no physical location or central exchange, as it is a what? Global decentralized market that trades blank a day, blank a week. So this is time. So this is asking you blank a day and blank a week. I don't know how to say it. Okay. We know it's not physical. We know that it's we can connect through the internet, right? And it's global. It's decentralized, right? There's no one marketplace that monopolizes the Forex market, right? But we can trade it. How often can we trade it? 24 hours a day, 5 days a week. Okay. So it, it yes, because it closes Friday at 4:30, opens Sunday at 5. Okay. So yeah, 24 hours, but once it's open on Sundays all the way through Friday afternoon, you can trade it 24 hours a day. You can get in the market anytime over a 24-hour period each one of those days. So the smallest unit of measurement we use when trading currencies is called a what? How do we measure the smallest unit? So like we use what is our smallest unit of time that we speak of is a millisecond. We don't actually say millisecond, but we say seconds, right? So the smallest unit of time that we may use, if somebody's running, they ran in 10 seconds, right? Or they ran it in a minute and so many seconds, right? So that what is our, how do we keep track? And the purpose of this, when you think about it, is like this: if I have the U.S. dollar and you have the Japanese yen, and we're trying to converse about, we took a trade and how much you made in your yen and I made in my US dollar. And for me to really understand it, what that really means, we have to have a unit of measurement that we can speak the same language on. And that is called a pip. A pip is the smallest unit of measurement we use when trading currencies. Okay, it's called a pip. So now, if you say you made 100 pips, I know what that means, and I can look at my chart. And if I took the same trade, even though yours equals something different in yen than mine equals in a dollar based on exchange rate, I can say we both made 100 pips. Though you just made it in what 100 pips means in your dollars as opposed to what it means in my dollars. Okay. Now, for pairs like EUR USD, see, there's a pair, that's two currencies coming together, GBP USD, etc. A pip corresponds to the what decimal digit. So it told you that there are some decimal digits that the pip corresponds to. Okay, so there are several digits. We throw off the last one. Okay, we don't even count the last one. That's our little millisecond. That's a pipette. We don't count it. So what digit do we start counting from in the decimal place? I almost said it. It's the fourth one, right? It's the fourth decimal digit. You guys will learn that. You'll see that. You'll hear us say that. No worries. I'm going to show you that over and over again. But you guys will, when we do the demonstrations, I'll go over this part again. But I just want you to understand it's the fourth decimal digit. All right. But yen based currency pairs like USD JPY, Y represents the yen, JP is Japanese, Y is yen, US is US, and the D is dollar, US dollar to the Japanese yen. So that's a currency pair, that's a yen based pair, are the exception, and they're measured to blank decimal places. Okay. So we're talking about the pip. Okay. So the pip is measured at the second, right? Two decimal places. They have three decimal places, behind the decimal, but we don't count that third, that far one, all the way over the third one. We start counting at the second one. Does that make sense? Because we throw off that last one. We don't want the last one. Okay. Now the blank price is the price a Forex trader is willing to buy a currency pair. Do you guys remember that? There was one of that. There's a price that we listed where we were willing to buy it. There's a name for that. And there's a one for selling. Do you guys remember what it is? Hope you have in your note as the bid price. So the bid price, you're going to see it on your chart, is the price a Forex trader is willing to sell the currency pair for, or pretty much offer it at, but sell it for. And then the other one, what's the other one then? If you know one is the bid, the other one is the what? Ask. Correct. The ask price is the price that the Forex trader is willing to buy a currency pair for, right? So the ask price, asking to buy, when you see ask price, that's the buying price. That's the price you're willing to buy it for. And the bid price is when you're willing to sell it for. It seems kind of somewhat different, especially the bid one. But because to me, if I'm bidding, I'm actually willing to buy it at a certain price, it seems like. But that's not how we're learning it in Forex. Okay, so let's keep it moving. We have one more after this. The blank is the difference between the ask price and the bid price. What's the difference between the two? And this is a very important. You might not remember asking bid price that much. You don't really have to know that, but this one is important. Okay, the difference between the two is called the what. You're going to hear this. You're going to learn a lot about this. This is the spread. The spread is the difference between the two, and the spread is what you give back to the broker. The spread is what you give back to the broker. And you're going to be like, I thought I got in at this price. Why in the world did I get in at this price? It had to do with slippage and the time you got in. But also the spread, like if it's a 2-pip spread, which is kind of high for a liquid pair, very liquid pair. Like if it's a 2-pip spread, that means you have to wait 2 pips before it actually triggers your trade or exits your trade. That 2-pip, or it may knock you out because it was only 2 pips away, right? You 2 pips away, but that spread hit you and knocked you out of trade. So you got to pay attention to the spread. Very important. And you guys will learn about that as you go along. And the 7 most traded currency pairs in the Forex market are called the what? They are all traded to the US dollar. But what are they called? You know the name of it? The 7 most traded currency pairs in Forex are called the majors. And they all have the US dollar in them. Because the US dollar right now is the reserve currency of the world. So GBP USD, EUR USD, AUD USD, USD JPY, USD CAD, USD Swiss franc, like all the USD something pairs are the major pairs. And the ones that aren't the major pairs that are still popular pairs that are traded across from each other, like GBP, JPY, that's a cross pair because it doesn't have the US dollar in it. And then there are the exotic pairs, like, if you're trading with the African rand, the ZAR, then that's an exotic pair, right? And so there are reasons why we trade some and the other ones are not as stable, not as liquid. And so you guys are going to learn about that as you go along. But that's it for this lesson. The next lesson that you guys are going to need to go to is Forex basics in practice. So I'll see you guys in that next lesson. Great job on the quizzes. Great job on taking notes.